Hi to IPO subscriber. Welcome to EagleWave.ai. Today, let us review the assembly IPO from Credit Connect NK Limited. Here we go on IPO review. First, let us start with the financial analysis because the fundamentals are more important than any other factor to take any decision for investment or to subscribe any IPO. This is the financial analysis report generated by AI-powered software. And based on inputs given to the software, this company has been categorized as a healthy company. Now let us see what are the financial strengths that made the company healthy company. First, let us see health analysis. In health analysis, solvency. Solvency ensures the sustainability of the company. Here, all the metrics are positive. So, solvency is strong. Next, coming to liquidity. Liquidity ensures the survival of the company. Here, liquidity is very strong. Current ratio is 2.05, quick ratio 2.05, very good. Coming to operational efficiency, only receivable turnover is a little bit less compared to a benchmark of 7.8, it is 5.58. Otherwise, operational efficiency is okay. This will be changing from time to time. So we need to be concerned about this negative metric. No financial irregularities. Profitability. EBITDA 29.08, EBIT is 25.97, PBT is 24.59, PAT is 18.45, cash profit is 21.55, EPS is 13.95, very good. EBITDA margin is 13.56, okay, almost close to 20. Net profit margin 8.61, ROC is 61.81, very good. ROE is 40%, very good. Book value per share is 30.03. And coming to cash flows from operating activities are minus 6.62 crores. Net cash flow is positive 1.25. So coming to market values, so this is the 189 is the cap price taken from IPO. So based on this market price of 189, price earning ratio is coming to 13.54. Okay, very good. And coming to price to book value, which is 5.72. It should be less than 3, 5.72. Let us see the projected, what you call PB. Then we can have a decision whether to go for IPO subscription or not. So, coming to growth indicators, all are positive. Whatever the metrics are available, all are positive. Very good. This is about the company. Now, let us go on IPO review. So, here is the IPO review. Is a Credit Connect NK to IPO attractively valued? And does it healthcare logistics business offer enough growth potential for investors? That is the question. Let us take a quick look at the business market opportunity, valuation, and investor sentiment. Business overview. Credit Connect NK Limited is an integrated healthcare services and logistics company operating primarily on B2B model. Key business areas: healthcare services for hospital, laboratories, and healthcare companies. Home sample collection through trained phlebotomists. Sorry, I could not pronounce it properly. A laboratory and paramedical manpower services, healthcare logistics and temperature controlled transportation, and cold chain logistics for diagnostic samples, reagents, and medical supplies. Technology-enabled logistics through the C3 Post, workforce management through C3 HRMS, and service to diagnostic laboratories, IVD, and pharmaceutical companies. The company operates in a segment where diagnostics growth, healthcare outstanding, and cold chain requirements can support long-term demand. Market opportunity. The company is positioned to benefit from several structural trends: rising demand for diagnostics testing, expansion of organized healthcare into Tier 2 and Tier 3 cities, increasing need for specialized cold chain transportation, growing outsourcing by hospitals and diagnostics companies, technology adoption in healthcare logistics and workforce management. Overall market outlook positive. IPO and use of funds. The IPO is 93 rupees, 90 paise, sorry. The IPO is 93.9 crores. A fresh issue at a price band of 179 to 189 per share. The proceeds are primarily intended for working capital, very good, investment in subsidiary, okay, machinery and capex debt repayment. Only investment in subsidiary is the concern because the company would not get anything out of that. A positive point is that the issue is entirely fresh capital, meaning the IPO is designed to bring new funds into the business rather than providing an exit to existing shareholders. Very good. Valuation, key investor focus. Now comes the most important question. Is the IPO expensive? Key valuation number. EPS 13.95, PE 13.54, push, PB is 5.70. At 13.54 earnings, the valuation appears reasonable for a company operating in a growing healthcare service segment. However, there is a valuation concept, that is PB, that is 5.7. The company is being valued at a significant premium to its book value. The projected numbers bring the valuation down to approximately projected PE 12 and projected PB 3.63. What we need is it should be less than 3. It is about 3.63, a little bit higher. This makes the valuation more comfortable only if the company can sustain its projected high growth. Yes, of course. Investor takeaway. The IPO is reasonably valued on earnings but expensive on book value. The projected 131% earnings in CCR is particularly aggressive. Investors should therefore avoid valuing the company solely on these growth assumptions. Okay. Market sentiment. The IPO structure provides for QIP up to 47.34, NIA up to 15.01, retail up to 35.11, and market maker up to 5.07. The high QIP allocation provides room for institutional participation, of course. For the latest sentiment, available market charter indicated a positive tone. With the Credent Connect NCARES reported GMP around 189 on August 11th, equivalent to roughly 18% above the upper price band. However, GMP is unofficial and can change quickly, so investors should not treat it as a fundamental valuation indicator. Subsection data should ultimately be given more weight than GMP. A strong IPO is generally more convincing when demand is broad-based across QIP, NAE and retail categories rather than being driven by only one segment. Market sentiment positive, but valuation sensitive, of course. Key risks to watch. Investors should monitor high working capital requirement, dependence on sustained high earnings growth, related party business exposure, and deployment of IPO proceeds into the subset. See, this is a concern because the company is not going to get any additional productivity from this repayment, deployment of IPO proceeds into the subsidy. So, adequacy of insurance coverage, execution risk in expanding operations. Final investor review. Business healthy, strong positioning in healthcare services and logistics, growth positive, diagnostics outsourcing, cold chain, and technology adoption provide attractive growth drivers, valuation moderately attractive. 13.54 into PE is reasonable, but 5.7 PB is expensive. Market sentiment positive. Current market indicators are supportive, although GMP should be treated cautiously. Final verdict. Credent Connect NCare IPO offers a combination of a healthy business, attractive healthcare sector growth, and reasonable earnings multiple. However, the premium PB valuation and the very high projected growth expectations are the key areas investors need to watch. Investor view, moderately attractive, good business plus reasonable PE plus positive market sentiment, but premium PB plus high growth expectations equal to valuation caution. Very good. So, closing, for investors, the key question is not whether the Credent Connect in healthcare can grow. It is whether the company can grow fast enough to justify the premium valuation. That's what about the company IPO. So, as always, investment decision should be based on your own financial goals and risk tolerance. And thank you for watching. If you found this analysis useful, please like the video, subscribe to the channel, and stay connected for more detailed IPO and stock market research. Thank you very much for watching this video.